welcome back to the fourth revolution, where I discuss stocks for your portfolio of the future. And those stocks of the future are reporting this week. And 1/3 of the S&P 500 is actually reporting in this precipice of Q1 earnings season. And, earnings have been tremendous so far. I knew we'd see beats, but not to this magnitude. I mean, we've had unbelievable top line and bottom line growth figures that estimates were not even close to on a lot of these big tech names like Apple and Facebook last night. Completely blew out of the park their expectations, and Apple just justified its current price level and lofty valuation with massive beats on the iPhone. It's kind of solidifying its super cycle with the iPhone 12, but that wasn't the only product line that was driving growth. Their Mac sales were up 70%, iPad sales were up 79%. The subscription-based services, which is considered their consistent long-term revenue growth, was up 27%. And a lot of this has to do with this transition into the hybrid mobile functionality environment as people realize that working from home isn't just a temporary thing. It's going to be with us for the long haul. But that wasn't the only beat. We had Facebook come out with massive 40% beat on EPS, illustrating revenue growth of 48% and income expansion of 94%. And this is driven by their ad revenue. And this is the same story with Google. They had the same huge ad revenue beat. And these platforms drive an enormous amount of engagement, and businesses know that they need to start spending on this kind of advertisement if they want to keep their company thriving into this new normal. There wasn't all roses, but like I said, a beat wasn't enough in this earnings season. We had to have a tremendous beat to justify a lot of these lofty valuations. So we had beats across the board for some of my favorite stocks, and we still saw negative price declines from stocks like Microsoft, AMD, Spotify, Pinterest, Netflix, and Tesla. These dips could be a opportunity for a buy the dip, motion here, but I think it's time that we dive into the charts and really take a look at what's happening here. So this is Google over the last 6 months. You can see it's kind of had like this stepping stone kind of phenomenon with its trading as these earnings get increasingly impressive, and it's all because of this recovery trade that people are associating with Google. And it's not the first thing I would think of when I think of Google. I mean, I would think engagement would be larger when we're stuck at home, nothing to do. But the fact of the matter is people are researching travel, they're researching events, and they're ready to get out and about. And Google is the best, online conduit to help them do so. And you can see, comparing it to the SPY here, over the last 6 months, let's get an exact 6 months here, we have pretty much doubled the S&P 500 year to date. We nearly tripled it. And, coming out of this earnings report, obviously ad revenue was a huge driver. Businesses are spending a lot more, like I said, on these engaging platforms like Google and Facebook. But what really impressed me out of this quarter was YouTube. The company had revenue guidance for YouTube of 29 to 30 billion, which is matching Netflix's full year guidance. People are using YouTube just as much as they're using Netflix because of those short form videos. And YouTube is just one small facet of this diverse tech powerhouse's revenue drivers, and it looks like they could surpass Netflix for content consumption in the coming years. But going back to this ad revenue spend, you can see Facebook here jumping 6% today on this big beats on ad revenue. And this company, they traded sideways more or less, consolidating their stock since the end of August. But we're hitting new all-time highs today, and it's justified. This company is a powerhouse for social media with 3.3 billion users on a monthly basis, and that's more than half of the internet using world. And what better way for a company to advertise their products than with Facebook's diverse portfolio of social media engaging platforms. And you can see that with the stock today driving higher, and I can assure you we're going to see some re-ratings to the upside on Facebook. I've seen them, north of even 500 for some price targets. I'm not chasing this rally right now. Let me just justify. I'm a little bit concerned for Google and Facebook about regulatory overhang regarding this targeted advertising. as well as some of the content censoring that the DOJ is all over Facebook on. So like much of the tech sector, you can see Apple has consolidated since the beginning of September here, where it hit a high, hitting a new all-time high in January, but kind of trading sideways since then. And we had a great earnings last night. The company reported beats across the board with, like I said, computer and iPad sales that were just out of the park. And even their service revenue sales were great. And I really want this service revenue to be a large driver in the future, as this is the consistent, reliable revenue that a lot of these Silicon Valley powerhouses are focusing on. It's the golden model, the subscription based model. And Apple has been trying to transition to that because obviously the iPhone and their product lineup are pretty cyclical as far as their releases go and the revenue that they drive from those. And with this new service lineup, Apple TV Plus, Apple Music, Apple Care, and a bunch of other things that they're starting to release are going to be the long-term drivers that investors rely on for this consistent revenue. You can see, even with this huge beat, the stock's trading barely above what it's closed at yesterday. And I think a lot of this is because, we're concerned about what this company is going to look like in the months going forward, in the quarters going forward, because, a lot of this revenue has already been attained over the last 4 quarters as people are starting to realize that this hybrid environment is more permanent. This hybrid work environment is more permanent than we think. And I don't think that, there's going to be as big of a jump in the coming quarters. But once again, tremendous earnings from Apple. And, this company is still a staple in many people's portfolio, but I am not a buyer today. I know you'll probably hear from a bunch of people on CNBC saying, buy and hold. This stock is a long-term value stock, but the stock's trading at close to 30 times PDE, and a company that doesn't show 30-40% growth is a little bit concerning with that high of a multiple. And with the Fed considering tapering in the coming years and interest rates only looking up from here, I think a company like this has some contraction in the future. But I've been wrong on Apple in the past, and I could be wrong in the future. So Microsoft falls under this GARP category, growth at a reasonable price. And you can see we've had just this massive secular upside since the March lows, surpassing its February highs pretty quickly in the COVID environment and just continuing higher and higher. And you saw that going into earnings. Obviously, we were hitting all-time highs prior to this earnings report earlier this week. But the company, they beat top and bottom line estimates. They showed healthy growth in their Azure platform, which is their cloud computing platform, with over 50% year-over-year expansion. And overall, this was a super healthy earnings report. But the company is seeing some profit pulls with down almost 3% yesterday, down over close to 1.5% today. And this could be an opportunity to pick this stock up. I think we've been trading pretty closely along this 50-day moving average, which is in blue here. And if we can come back down to it at around 243, I think this is a buy. I'm a buyer on Microsoft on every dip. And I think this stock, it was the biggest stock at the turn of the century, and 20 years later it was the biggest stock in the world. I think this company is just a powerhouse of innovation that just doesn't end. So I'm a buyer on this dip for Microsoft. Like I said, tremendous earnings, weakness in the stock. This is time to add to Microsoft. So don't forget to check out the remainder of this earnings season. We have Amazon tonight and a plethora of other smaller cap tech earnings in the following weeks. And there's no shortage of excitement coming towards us. And market volatility obviously is leveling out, but once all the dust settles, I think we could see a bit of a pullback. A lot of analysts are expecting, somewhere between a 5 to 10% pullback in the next 6 months or so, with the stocks going nowhere but up in recent days. So watch out for the coming earnings as our Q1 earnings season comes to an end. Don't forget to check out Zacks.com/promo, where we have Zacks Investor Collection, as well as 5 stocks set to double. And I am a co-editor on that one. So don't forget to check that out at Zacks.com/promo. Thanks for watching, guys.